Folks, I want to introduce you to something today, teach you something important, and show you something really, really cool that can help you make a lot of money, potentially. Now, what you're looking at right now is the microcap iShares ETF. I know it's a lot of words, but what this is, it's an index. It's like the S&P 500 for microcaps, all right? For small stocks. Stocks that are just getting ready for prime time. Now, I'm going to tell you something or teach you something really, really important right now. Pay attention. This is something you want to put in your trading toolbox. The smaller the stock, the smaller the asset, the more speculative value it has. The bigger the stock, the more investment value it has. Now, what does that really mean in a practical sense? What it means is simple. If you're going to be trading a small penny stock or a stock for $1 or $2, usually you'll see a lot of volatility, a lot of liquidity, a lot of movement with a stock like that, percentage-wise, in comparison to a stock like a Dow stock, like Johnson & Johnson or Kodak, for example, back in the day, or even a huge conglomerate like Caterpillar, okay? You'll see a lot more volatility as the stock gets smaller. So, for example, the volatility on the SPY, the S&P 500 index that tracks the 500 S&P stocks, may be 1% or 2%, whereas the volatility on a medium cap index like the Russell 2000 may be 6-7%. And when you get into a micro cap index such as this ticker symbol is IWC, the volatility may be as high as 10-11%. And that means the more volatility, the more risk, but it also gives you more upside potential. But that's just one of the elements of microcap stocks. Here's something you really need to understand. The smaller the stock, the more this trade war with China impacted its value. Because the more the speculation, more speculative the stock is, the more it got involved in this trade war. If you look at a large cap stock like Caterpillar or, again, like Apple, they have several different products and services. If China impacts one, they've got other ones. When you're looking at a micro cap stock, you're looking at one-trick ponies. These stocks have a lot less market capitalization. So they tend to be impacted by bad news long before large cap stocks are. And similarly, they're much quicker to be impacted by good news than large cap stocks. And right now, US and China are making nice. They're getting along. They're becoming friends again. We're about to have an official signing of the phase 1 of the trade war. And notice what's going on with small caps. This is a weekly chart. This is not a daily chart. So you're really looking at fundamentals here. If you look at the weekly data, we're trading above the 50-day moving average. It's the first time since this trade war started in November of last year, roughly, when China and Trump, all the bad stuff happened. And they've been kind of moving sideways. The Fed's been lowering rates, giving stocks support. They haven't entered a bear market. They've been hovering around the 200-day moving average. And finally, a few months back, they began breaking out. And as long as this thing with China and US continues, you're going to see a lot more upside in smaller stocks, especially on a percentage basis, than you will with the S&P 500. Now, this is the S&P 500 on a weekly basis. And you know what? It's overbought. It's been overbought the vast majority of the last 2 months. Moreover, on a weekly basis, and weekly technicals are strikingly in line with fundamentals. So we're seeing a overstretched market. More important, not only are we overbought, we're seeing divergence. We're seeing a severe uptrend in the S&P and momentum levels that can't go higher, meanwhile remaining overbought. This is not positive. Now, does it mean the market's going to come to a crash, the world's going to end? No. It simply means that the S&P, the large caps, are way overdue for some downside movement because they're overbought. That rubber band is stretched out like this, okay? And the small caps, look at what the large caps have been doing. They've been moving straight up. Meanwhile, the small stocks, they've been just sitting there. They've been waiting. They've been sitting, waiting, gaining energy, waiting for a breakout. And that's what they're doing. And they have a lot more upside in the near term and maybe the next 6 to 8 months if we continue to see progress with the trade war. But there's something else here that you need to know, something really, really important. Remember I said large caps are overbought? Well, they're not just overbought on a technical basis. If you look at the profile of the S&P 500, you will notice that the PE ratio is really close to 20. It's at 19.67 to be exact. And if you look at the micro stocks, the micro caps, their PE ratio is only at 13.14, substantially, and I mean substantially less than the S&P 500. And if you look over stock history over time, stocks with a smaller PE ratio or a tighter PE ratio tend to outperform stocks that have larger, especially indices. Usually these indices, the S&P, the Russell, their PE ratio will be in line. But right now, and usually the small caps will be on the upper end of the range. Right now, these microcap stocks are cheap. I mean dirt cheap. They are grossly undervalued. They're just now taking into account that the Fed has been lowering rates, that the trade war potentially could be over. This is 9 months. Notice just sitting here at the 200-day and the 50-day moving average and began moving up just at the end of November, which is when the spider began, the spiders, the S&P 500, began to become really, really overbought on a scale. I mean, as I said, that rubber band is stretched out, just stretched out right here. Look at that. That's divergence. So again, if I was looking at stocks right now, I would be looking at small caps. They're breaking out. They have a lot more upside because remember, stocks always look ahead and discount everything that's known about the market. And right now, stocks are looking ahead to the resolution of this trade war. Last November, they were looking to the beginning of a trade war, and they went down, and they've been moving sideways. I'll show you that right here, as you can see here in this chart, right here. But during that time, after that time, with the Fed stepping in and saying, "Hey, economy's moving in a good rate. We're not going to be raising rates." They've been just congesting, moving sideways. And the rule of thumb is this: the longer a stock congests, the better the odds it'll begin trending. And the longer a stock trends, the better the odds it'll begin congesting. Well, the S&P has been trending for a really long time, and the small caps have been congesting for a really long time. I'll leave you with that. Like I said, I expect small and microcap stocks to crush the market in 2020. No, not just do okay, I mean crush it. And while you probably do okay buying an ETF that tracks smaller companies, there's a much, much better way to take advantage of this massive, massive, massive opportunity. Cyborg, my most aggressive system to date, has the potential to grow your account 660% in 2020, substantially outperforming the stock market. It only holds the top-rated small-cap stocks and has proven to generate option-like returns without any of the hassles that comes with options. Come Thursday, January 16th at 7 p.m., I'm going live to give you all the details of my Cyborg system. Plus, I'm giving away my #1 stock to anyone that attends. That's right, my #1 stock. You don't want to miss this one. Make sure you click the button below to register. It's completely free as long as you RSVP.